Sometimes it doesn't have anything to do with the actual financial outcomes or stability of the business. It could be still an amazing business, but someone gets caught up or a bad article comes out in the news and 20% is wiped off in the day. So yeah, do you want to talk a bit, Billy? Why don't we go into the direct shares? This is a real example. Talking even before we got on here around some client scenarios of some clients that have got some money in individual companies and it's fallen off a cliff.
We've seen it time and time again. Like the vast majority of the time, if you go hard on one company and one stock and you're reading all the press releases, reading all the media about it, reading the company reports, analysing it to death, and you're really investing in that one company, there is a very high chance you're going to blow up your capital because you've got emotion tied into it as well. Now you've invested so much time and energy and research into that one business. If it starts to go wrong, it's very hard for you to make the call to sell and move on. Yep. Very, very hard. We've seen it so many times. Same with company share schemes too. Like you work for a big company, they're giving you shares over a number of years, you build up this massive holding in this one company. It starts to go south. It's very hard to make the call to sell. So we don't stock pick because
All right, welcome back to the Winners Playbook. Josh here with Billy. Today we're going to be diving into quite a few different topics. We're going to be talking about testamentary trusts and what's actually happened post-budget announcement. So the government's actually walked back on some of the proposals here, which are quite interesting, and we're going to be breaking those down. But then more importantly, looking at what actually a testamentary trust is and how do they work. Moving on from there, we're going to be talking about some of the risks of investing in direct shares. We're going to be talking about a particular company question here, which is WiseTech, which some news has just come out in the AFR lately, and the share price has actually dropped 20% in one day. So we're going to be talking about why we don't actually invest in direct shares here at Link Wealth. Then we're going to be moving on to a bit of a SpaceX update. We're probably talking about Elon Musk the last few weeks, so it's pretty topical. But talking about some other interesting listings coming up being OpenAI and Anthropic and how this could have some possible impacts on the likes of SpaceX and some other businesses out there. And then we're going to be finished on talking about the age-old question, is early retirement overrated? And I had some interesting client scenarios coming up in the last few weeks, which I want to dive into. And yeah, let's maybe kick it off, Billy, and start talking about the testamentary trust. So maybe before we talk about what a testamentary trust is and who they're for and what they're used for, what originally came out in the budget and then what has now happened?
Yeah, so the stuff around trust is interesting because, you know, what was the goal of this government with these changes? Obviously, it was to raise more tax revenue, but it was also this intergenerational fairness thing. So a lot of wealthy people use trusts, right? So they want to hit trusts. However, they captured in that big change on trusts, they've captured testamentary trusts, which they're not just used by the wealthy and they're not just used for tax advantages. So yeah, there was a bit of a few people pushing back on that. So the changes to trusts, the big one was that any income that comes out of a trust, they're applying a minimum tax rate of 30%. Whereas up until now, if a trust distributed to a child or to a person with low income, for example, they weren't subject to a minimum tax, they just paid normal income tax rates, which was often lower than 30%. So what they're walking back on is they're saying testamentary trusts will be carved out from that minimum 30% and it'll basically stay as it is currently.
Yeah. And do you come across too many testamentary trusts? I every now and then, but it's pretty rare that I come across testamentary trusts.
It's rare, and they're underutilized. Like they should be used more because we've seen so many horror stories with estates and money not going where it should go. So there's a number of reasons to use these, and a lot of them are not around tax. Yeah, they're around control of the family's wealth after you're gone.
Yeah. So do you want to dive into them? What's actually a testamentary trust and a bit of who they might be for, but what's a testamentary trust?
Yeah, so it's a type of trust that is only created at death. So you'll have it stipulated in your will that when you pass away, a trust is created for your beneficiaries, usually children, maybe grandchildren, and then assets will go sit in that trust, and then money is distributed out of that trust in line with your wishes. So you'll stipulate in the will how and when money is going to become available to beneficiaries after you're dead. Right, so all the money's in the trust. You might have kids and grandkids as beneficiaries. If they're under 18, for example, you might say they don't have any entitlement to the money until they're 18 or 25 years old. You might stipulate that they're entitled to income from the trust, but they can't just take the assets out.
Yeah.
So you can put all these rules around it, and there's lots of reasons that you would want to do that. So one is if you have, let's say, an adult child and they've just entered a relationship and you don't trust the partner, or there's a big wealth disparity with the partner, because what you don't want happening is you pass away, your child ends up with a bunch of money, relationship ends, and then that partner could potentially take a big chunk of it and walk away with it. So using a trust can help prevent that. Then you'll also have children where they're not able to manage that money. They've got a drug problem, an alcohol problem, a gambling problem, been unemployed for a really long time, mental health. There's all these reasons why you might not want your kids to just receive a big chunk of cash when you pass.
Yeah.
So use a trust for all those things.
Yeah, interesting, because I'm actually going through the process of updating my wills as we currently speak, because I had my wills powers of attorney done a few years ago, but that was before Leon was here. And so now we're going through the process and we're having the conversations with the lawyers around, what are we doing? Do we utilize testamentary trust? That looks like the route that we're actually going down, because I think the big thing I find interesting around testamentary trusts, which differ to a regular, say, family trust, is with your regular family trust, any income distributed to a minor, so say someone below the age of 18, is basically taxed at the minor tax rates, which are some of the most horrendous tax rates that are in Australia. You can essentially put $416 to a child below age 18. And other than that, then it's pretty much taxed at the highest tax rates that you can see in Australia, which is for good reason, because they basically want to stop, not wealthy individuals, but people just streaming income to their kids, and they're just getting a tax advantage. But with a testamentary trust, you're generally going to be benefiting from the ordinary tax rates. So you can actually distribute through to kids, through to minors, and they're getting the tax-free threshold. So you can virtually earn up to, say, 22,000 or thereabouts. In Australia, you don't pay any tax on that whatsoever. So that's definitely, I think, a positive outcome that's come post-budget. I know there's still lots more to be done, and still the business community is still fired up around a lot of it. And I know there's still a lot of consultation going on, because I see it online with people I've even got on LinkedIn that are really getting amongst it. But I think that is definitely a positive. And I guess, like, who are they for? There was one thing you mentioned before, which is probably the most common scenario I speak to my clients around, is you've got your kids, they're going to have their own relationships, hopefully in future, that they get married, and then what if there's a marriage breakdown at that point in time? So another way I've referred testamentary trust referred to is blood trusts. So it's like you're trying to really keep that wealth in the family. And I know it starts to get a little bit tricky though when there is a marriage breakdown. Let's say it goes through like the family courts and it's going to the courts, and say it gets really nasty. There are still ways where that trust could possibly be penetrated. And I know, because I've had conversations around this, that's where, say, for your kids, not that I have to worry about this, but like if I imagine, say, Leon was 25 and if I was doing this and he had his own partner and he was getting started with life there, I might want to get him to put in like a binding financial agreement with his spouse as well at that point in time, as another layer of protection, as opposed to just having the testamentary trust and then all of the wealth goes there if something happens to myself and my wife. But even then, having another layer of like a binding financial agreement, having that conversation around, all right, you guys are going into this. This is how it's all structured, and this is what's going to be agreed upon. Have you seen too many binding financial agreements with clients before?
Not a huge amount, because a lot of couples just don't do them, because it requires each member of the couple to see separate lawyers. Right, so it costs a fortune, because you're engaging two lawyers. You obviously have to negotiate and agree on the terms and put that in place, and then there still aren't really guarantees around it, right? No. So it will help protect wealth. But the family courts, divorce and all that stuff, it's all based around fairness. It's not black and white the way that estate planning is. It's around, needs of each member of the couple, who contributed throughout the relationship, all that stuff. So a BFA is never a guarantee, but certainly if you have one person with a ton of wealth and the other person doesn't, then it's still worth going through the exercise, I think. Yeah,
I'm thinking in my mind, like, what sort of wealth threshold might be relevant, and it might be more of that, emerging, small family office type scenario where, I don't know, maybe what if you've got maybe $5, $10 or $15 million in terms of your net worth, or something along those lines. Like, it's probably not relevant if you've got $1 million or $2 million in just a house or something of sorts. But
correct, and it's if you came to the relationship with that wealth already.
Yeah,
right. So it's usually old money, like your parents, grandparents' money. That's where it's more relevant. Not so much if you're high income and you build a lot of wealth during the relationship. That's not relevant for the BFA.
Yeah. And I've heard some horror stories. I know if things blow apart and the parties aren't on the same page, it kind of doesn't really matter, and it can get narky, and the lawyers' costs, and it's a slippery slope, that one. Yeah. What else did I want to talk about here? So we touched on the vulnerable beneficiaries, or I suppose beneficiaries that lack financial maturity. So maybe you've got someone who is over age 18, but you can't trust them to manage that wealth. So you might want to lock it away in a testamentary trust for their long-term future. The other one we've spoken to some clients around as of late, and I've had some pop up just recently, is around clients who want to leave their wealth to their kids, but the kids are adults, but the kids are actually in their own businesses. So if they inherit any wealth that goes through to their individual name, as a business owner, you generally try not to have any sort of assets as best as you can in your name, and you try to avoid that. But if you're inheriting all of this wealth through, say, your parents' estate, and that just goes in your name, well, then that could be opening it up for asset protection purposes in itself. So I suppose that's another common one I might see for clients, is they just don't want to go through it. The kids won't even want it in their own name anyway. So you try to lock it away through the testamentary trust structure. And I suppose, like, with the testamentary trust, like, what can you invest in?
Oh, it's like any trust or any entity. You can buy shares and property and all that sort of stuff.
Yeah. And because you can really set, I suppose I've also heard people say it's like, I guess you're kind of ruling from the grave in a way. You kind of set the parameters around.
There's a funny term, what's called dead hand control or something like that.
Yeah, I heard that. So
it's all pretty grim.
You can set the parameters around how it's basically going to operate. And then I guess importantly to know, with the testamentary trust, there's usually going to be definitely there's professionals involved, because there's going to be accountants and lawyers at a bare minimum in there. And then there's usually going to be an advisor involved, because lawyers would generally recommend you get an advisor who's then going to be helping you or helping actually manage the investments of that trust. So there are some real key particulars there, and you are talking about a cost to administer and operate a testamentary trust.
So you definitely need advice on this stuff. And I was just say, like, the alternative to that, and what wealthier families do, is they'll have a family trust, right, that just exists through multiple generations. And beneficiaries change over time and so on. That's what the tax changes are targeting, those sorts of trusts, where there's a ton of money there. It's not one created on death. It just exists, and it's got assets in it, and it's making distributions every year. That's where they're trying to really impose that minimum tax rate. There's a lot of kids and grandkids that are benefiting from those sorts of arrangements.
Yeah, makes sense. And I've been talking to a lot of clients recently, like not even high net worth individuals, but clients that are maybe worth a few $1 million, but then they might also have life insurance that will be paid out upon their passing. So when you put the family home, maybe an investment property, you got some superannuation, some other investments, and then you throw some life insurance policies on there. The average person can quite easily get up to an estate of $5 or $6 million quite easily, depending upon the types of life insurance. You might hold a $3 million life insurance policy because you're young and you earn a lot of money. So that's why I do have a lot of conversations with clients around this as they're scaling their wealth. And if you think all of that money and wealth going to a minor or someone who's even in their teens, there's no way they're going to be able to manage that. So
that's for the younger families. That's where it's relevant, is if you're relatively high income, you got lots of life insurance, super balances, if you have equity in the home, all that stuff. That's where it's still worth the exercise. So if something happens to you, you got kids still going through school, all that sort of stuff, you would want an asset sitting in a trust there that can distribute out, pay school fees, all that sort of stuff.
Cool. I don't have any other points there. Was there any other final points in that before we move on?
No, we're good.
We're good. All right, moving on to the WiseTech scandal. So WiseTech being a listed company, and we actually covered them, I think it was last year, when the Division 296 tax changes were coming out for large superannuation balances, and we were talking about a couple of the directors that had an immense amount of wealth of those shares owned through their self-managed super fund. I think it was in excess of $1 billion worth of shares. So we were talking about how that looked from a Division 296 perspective, but they were actually in the AFR for the wrong reasons in the last couple of days. And I won't get into the particulars of what's come out, but basically one of the directors has been caught up in some things that have come out in the AFR, and then the share price has basically dropped 20% in a day. And the reason why I wanted to sort of talk and bring this one up was really at Link Wealth, we don't invest in direct shares. And this is just one of the reasons why is there's just so much risk of investing in one company. We've spoken about it on previous podcasts, particularly when I suppose if you're a director, it's a little bit different in a large company because I guess you've got a bit of say and you know what is going on. But if you're the average investor and you're just stock picking shares, like you have no say. You have really no idea what's going on behind the scenes. And then when you see an individual share a large company like that drop 20% in one day, it's pretty horrific. There's more to it, but I guess the point there is sometimes it doesn't have anything to do with the actual financial outcomes or stability of the business. It could be still an amazing business, but someone gets caught up or a bad article comes out of the news and 20% is wiped off in the day. So yeah, do you want to talk a bit, Billy? Why don't we go into the direct shares? And this is a real example of it. And we'll be talking even before we got on here around some client scenarios of some clients that have got some money in individual companies and it's fallen off a cliff.
I've seen it time and time again. Like the vast majority of the time, if you go hard on one company and one stock, and you're reading all the press releases, reading all the media about it, reading the company reports, analyzing it to death, and you're really investing in that one company, there is a very high chance you're going to blow up your capital. Because you've got emotion tied into it as well. Now you've invested so much time and energy and research into that one business. If it starts to go wrong, it's very hard for you to make the call to sell and move on. Very, very hard. And we've seen it so many times. Same with company share schemes too. Like you work for a big company, they're giving you shares over a number of years. You build up this massive holding in this one company. If it starts to go south, it's very hard to make the call to sell. And these days, so we don't stock pick because if you're trying to pick individual stocks, you're competing, like everyone's in the same share market, right? You're competing with JP Morgan, Goldman Sachs, teams of analysts, algorithmic trading, AI tools. You're competing with all of that. A press release comes out from a particular company, all the algorithms and all that stuff, they can respond within seconds and sell down that stock if it's negative, right? As an individual investor, you don't have all those tools and resources. So it's very unlikely you're going to win. And even as a financial planning business, we do have resources, but we know that you just don't win at that game. And these days you've got low-cost ETFs, managed funds, thousands of strategies and products out there. You don't need to pick individual stocks anymore.
Yeah, chances are you're not Warren Buffett or Ray Dalio.
No, it was different 20, 30 years ago because that information wasn't so available and all those tools weren't available. So you could build a portfolio of 15 stocks and you'd do pretty well, get some good dividends and franking credits, all that stuff. These days, it's not the same, and share prices can move just wildly based on one piece of news or one tweet or whatever. So we don't stock pick. And when we see clients do it, most of the time, it's not adding value to them at all. And sometimes they lose a lot of money.
Yeah, no, the emotions are a good one. I've seen so many scenarios before, and I've even seen friends do this, when I was early in the advice game. Sunk cost fallacy, we've spoken about that a few times, where the company starts dropping, the emotions in there, and they start dollar cost averaging in to try and get their average price down, going with it. And it just keeps on going and going and going. And when you think about it as well, say you own a stock that's trading at $100 a share, say it drops 50%, you then have to make that stock that needs to go up 100% just to get back to where you were. So it drops 50% from $100 down to $50 to then get from $50 back to 100. It's got to double or grow 100%. I think a lot of people forget about that, and then that's why they start and try to dollar cost averaging in, and they're just throwing more money at it, and it can sometimes be like a bit of a falling knife type scenario.
I only saw it once where a client had bought a bunch of stock and it plummeted, and they said, I'm going to wait till it gets back up. They waited 10 years and it did come back up, right? It was like a lithium stock. They bought it in 2007, had a good run. Then following the GFC, it collapsed. And then obviously lithium became a hot thing again a few years ago. They rode it all the way back up. They bought more. They went way into profit territory and ended up, I think, with 1.5 mil in there. They'd invested maybe 200 grand in total. And then it collapsed. It fell out.
They sold out at the top.
No, they sold some. Luckily. I think they did a big renovation and stuff like that and went on a bunch of trips.
Jeez.
But then they wiped out 80% of their capital after that.
Well, that would be the few not.
But that's very rare. Usually it does not. If you've had 10 years of declining share price, it's going to zero.
Then you can only hold for so long and then you end up cutting ties. I don't know if I could hang on to something like that. I don't know.
Well, they forgot about it.
Yeah, I was
A
gonna
long period
say.
of time.
I was going to say that.
And I started stirring, and there was all this news about lithium and everything like that.
Yeah.
Then they got back into it. But
Yeah.
but that's very rare. 90% of the time, they're locking in that loss. So.
Well, I was looking at a few companies of clients I have that we've been speaking about employee share schemes and things in the last couple of weeks. And a few of the clients that I had that were quite invested heavily in those, which I was telling to sell and take some money off the table. I think in both scenarios, the share price from when I first gave them advice is down somewhere between 50 to like 80%. And they were so heavily invested in it. The share prices absolutely come off for not any reasons of things coming out in the news and media, but they just haven't met their financial expectations of the markets. So much wealth of theirs has been tied up into it, and it's had a massive impact on their life and their goals as well. So look, I don't think we could talk more of the risks of investing in direct shares. I don't even do it anymore myself. It'd be very rare I buy any sort of direct shares. Every now and then, like I will, but I put it in that 5 to 10% of the portfolio where it's a little bit of a punt in a way, or I want to take like really high conviction.
Boy, it's fun.
Yeah, exactly right.
It's fun. It is like, we don't want to call investing gambling, but there is that element. Like, you get excited when it does well and you think you're smart and all that stuff.
Yeah.
Like, it feels good.
Yeah.
But yeah, that should only be a 5 to 10%, as you say, just a fun bucket.
Yeah.
And if you make some money, you just treat that as a bonus.
Yeah.
The other factor with picking stocks is the trend. This thing that's happening at the moment. It ties into SpaceX. There's a massive amount of capital being sucked into AI and data centers, and now we've got these massive IPOs. So let's talk about that.
Yeah. So when we were talking and debriefing about the podcast yesterday, Billy, I come up with the term where the attention goes, the money flows. So very relevant to
Was that you or was that an AI?
Oh, I don't know. That was actually me. I'll claim that one, but I've heard that probably 1,000 times in my life, mind you. But it's very interesting because what we were talking about is sometimes the share markets, well, they can be manipulated for one, but sometimes they don't actually act in a rational manner. And even if you have great businesses that are super profitable and they're just amazing businesses, like you'd love to own it, sometimes the share markets just don't. There's just no love there, and the capital flow is just not going there whatsoever. And they're going for all of the shiny things, which is really, if you look at it, SpaceX, and then you got the likes of OpenAI and Anthropic. So you've been doing a bit of diving in there, and if you look at, well, where's the money come out of? We've spoken in the last few podcasts around, crypto, gold, like the capital has come right out of those two asset classes, and then you're seeing it still flowing towards AI and some other bits and pieces there. But what sort of figures have you come up with, and talk to us about what's going on with SpaceX now?
Yeah, so it's interesting, like the amount of money that's flowing into these mega cap AI stocks and data center build outs, it actually looks like it's depressing the share prices across the rest of the market, because there's all these good quality businesses making good profits, and their share prices are down 30% over the past 12 months. And I reckon that's a huge factor, and that we could see that accelerate the next 6 months. If we look at SpaceX, right, it floated, a week and a half ago, and then it was up at 50% from the $135 it floated out. I think it touched $200, didn't it? Just checked before, it was down 15% last night. Anyway, SpaceX, only less than 5% of the company's shares are currently publicly trading. Right, so everyone's clamoring over that 5% of the company at the moment. The other 95% is still privately owned. Obviously, Elon Musk is a big chunk of that, but there's also all the people that got in through private equity funds and private investors and all that. But what's going to happen is that 5% that's trading now, that's going to go all the way up to 100% over the next 12 months. So all the private investors are going to have the opportunity to sell on the public market if they want over time. And I've got some data here. So by the end of September, 20% of the company will be publicly traded. By Christmas, it'll be 40%. And by July next year, it'll be at nearly 100%. So even Elon himself, I don't think he would sell, but if he wanted to raise some cash, he could do that.
Yeah.
So there's going to be, if some of those early investors decide they want to take some profits, that's going to put a lot of pressure on the share price. At the same time, OpenAI and Anthropic, which is Claude, they are also doing a similar thing to SpaceX. They're doing these huge IPOs. So the amount of money that these groups are trying to mop up at the moment is insane. So we're either going to see those stocks do well and the rest of the market struggle, or maybe SpaceX will come crashing back out of orbit.
That's a good one.
I'm not good at those.
That could be one of the best
analogies or whatever.
Could be one of the best on the podcast.
Crashing back to Earth. Crashing back to Earth.
Oh, okay, that's interesting.
But yeah, we're going to see some huge moves one way or another over the next 6 months, I think.
Yeah, so are they, is OpenAI and Anthropic, are they listing this year? Are they trying to list
soon? Yeah, so both companies are planning to list in Q4 this year, like October and November.
Yeah.
OpenAI wants to list at $1 trillion and raise at least $60 billion, which is close to what SpaceX were doing.
Yeah.
Anthropic's similar, $1 trillion valuation and a similar size capital raise. But what's interesting is OpenAI is sort of struggling at the moment. Like, they're losing a lot of business to Claude, ChatGPT.
Yeah.
Anthropic looks far better. They're actually heading towards profit in the near future. So yeah, where's all that capital going to go? Is it going to keep pumping into all three of them, or are investors going to decide, let's dump SpaceX and jump on Anthropic? Or yeah, it's going to be an interesting period of time, that's for sure.
You know, I don't know why. It makes me think a little bit back when, was it around 2017, 2018, when all of those, like, what were they? The marijuana businesses were all the craze on the Australian Stock Exchange. Do you remember that?
Yeah, it was very short-lived.
Yeah, very short-lived, but there was so much hype then around it. And I remember seeing just a lot of money flowing in, and I don't hear anything of sorts. Like, it's just so out of flavor at this point in time. But it's interesting because I suppose there's a finite amount of capital in a way in the world, but then you can have central banks just basically print money for the cows to home. So you can always just print more money. But for the most part, there's a finite amount of capital. And so that money has to go somewhere. So I'm thinking about it kind of like the herd mentality is everyone's now shifting over here, and then it's come out of the likes of all those risk on assets, or crypto and some other sectors. Gold, I wouldn't really say is like a risk on asset, so to speak, but you've seen that money then come out of some of those areas, and now it's over here and it's circulating, it's pumping all up. And then it's like, well, where is it then going to go at that point in time? Does it go back to maybe some of the old sexy areas that it could or not? But it really is interesting. It's going to be interesting to see how, you know, the $1 trillion listings as well. Like, is that just moving forward? Is that going to become a bit of the norm? Like, $1 trillion?
I don't know. Either it's a bubble that's going to burst in the next 12 to 24 months, or that's how markets are. Yeah. I mean, like the data here. So last year in the US, if you add up all the IPOs and the capital raises that happened, it added up to $180 billion. Between SpaceX, OpenAI, and Anthropic alone, they're looking to raise $200 billion in the space of 6 months.
Yeah. It's incredible.
So where does that leave the poor old ASX too? Like there's just going to be not a whole lot of interest in Aussie listed companies.
Well, there's nothing really sticking out. Like what exciting things do we have going on?
No, I mean, you know, what may happen is that this all ends up being some sort of bubble, and then that starts bursting, and then investors go, okay, let's go back to actual fundamentals here and look at all those beaten down stocks that are down 50% that are actually really good businesses. Yeah. I hope that's what happens. Otherwise, investing just gets harder and harder, doesn't it? Yeah.
And so getting exposure, I suppose, in the likes of those, that's all going to be through, say, the NASDAQ 100. It's going to give you exposure.
Yeah. So with SpaceX, NASDAQ has decided to include them in the index. Yeah. I think now or in the next couple of weeks, it'll be part of the index. Mm-hmm. So if you're in an index fund that's tracking NASDAQ, you will own some SpaceX. Yep. S&P 500 stuck to their guns. So they've got rules around what to be included in the S&P 500. Like, I think they have to trade for a year. They have to be profitable or something like that. Yeah. So they've got some hurdles and they're sticking to it. They're saying they're not going to be in the S&P 500 for at least 12 months.
Which is interesting because they haven't always had those rules, have they?
I think they have, because I think NASDAQ actually made an exemption because they wanted to get SpaceX in there.
Right.
Yeah, so each benchmark or index has rules, and some of them adjusted the rules just around SpaceX because it's such a unique, such a massive IPO, and they had to figure out what they were going to do.
Yeah, which is then interesting because then for a lot of people in their superannuation funds, they might not get much exposure to some of these funds unless they've got particular ETFs.
Yeah, and there's been a proliferation of like space ETFs as well in the last 2 weeks.
Yeah, I've seen a few of those. I've had a few clients ask me questions. I know, like the beneficiaries, I think they might have been first to market on one, which is, what's the ticker code? I think it's space. I think that's the ticket code
Yeah.
that they've got. But no, interesting. Well, it's going to be interesting to see how it all plays out. And yeah, there's all talks of, is it a bubble? Is it not? Wait and see.
Yeah, and for people who want to invest in this stuff, this is a common misconception because you think, well, you could go, okay, Elon's been successful. He'll probably be successful. SpaceX is a good company. Look at what's called Starlink is really good. But there's that, but then there's, okay, that's fine. What are the actual numbers? Like, what is that company worth? So it's about what price you're paying. Yeah, like it's not just a matter of going, this is a good business with a good future. It's about, and what valuation? Because all the people who invested in SpaceX a year ago, 5 years ago, they bought it in a far, far, far lower valuation than what's happening right now.
Mm. And I had the idea of maybe Elon creates his own ETF or fund in future. He wraps all these entities in next. What was he got? Tesla, Starlink. He's got SpaceX, which I think is like part of that. He's got Grok, the Boring Company. I think that'd be a hell of an ETF. He'd like pull that together. Ticker code Elon.
Yeah, well, he might put it all together anyway. I read the ultimate goal might be Tesla and SpaceX merging. Then that way he can move cash around where he needs it and probably spend a shitload trying to get to Mars, I guess.
He's going to burn it all getting to Mars. Well, interesting. We'll wait and see how that one plays out. A bit of a change of gear here then. So in closing out, talking about early retirement, is it overrated? And I maybe want to lead this one in with some client conversations in the last couple of weeks. And I'm going to change some of the facts around what I was discussing with the clients. But basically it goes like this. You're in your, say, late 40s or very early 50s. Your home, say it's worth $2, $3, $4 million, whatever it may be. If you bought a home 20 years ago, that's probably pretty normal. But it's going to be worth something along those lines. That's fully paid off, so you're debt-free. Kids are they're independent or they're in their late teens, maybe early 20s, so likely still going to be living at home. In the scenarios that I was chatting with the clients, they're still living at home, they're going through university. But I suppose you're through the thick of the raising the kids, I suppose. You're through that part of life. And then you've got, say, $3, $4, $5 million or so built up in liquid investments. Maybe that's through investment properties, but the scenarios that I've seen, it was actually liquid investment options, ETFs and managed funds. And then if you think about that, like what would most people picture as an ideal retirement? Give me a $2 to $4 million debt-free home. Give me $4 or $5 million in liquid investments in the share market. That's going to have you living off $200,000 to $250,000 comfortably for the rest of your life if you invest that correctly. And so then the conversation was around, okay, so what do you want to do with yourself at this point in time? And if you ask the average person who didn't have that scenario, that'd be like, I've made it. Like I've absolutely made it. And now I'm just going to relax. Like I've worked hard and now I'm just going to coast for the rest of my life. But what was very interesting, I've seen a lot of this as of late, is the individuals I was speaking with, they've reached what most people would define as financial freedom. And then they're still greatly unhappy and they don't have any direction and they're not sure what they want to do. And they're like, okay, do I go back into paid employment, which some of these people were in? Do they go and do some consulting because, they're in their late 40s, early 50s and they've achieved rather good financial freedom. So they've clearly worked hard and an industry expert in what they were doing. Or do they look at taking a punt and buying a business? And so these were the conversations I was actually having with these clients. And it was quite interesting to reflect on it, because if you said to the average person in your late 40s, early 50s, you could have debt-free home, $4 or $5 million in the bank, most people I think would say, yeah, I've made it and I'm just going to do nothing and coast for the rest of my life. But in each of these scenarios, those individuals didn't want to do that. And now they're at a crossroads and lost around what they're actually going to do with their life, because they don't want to sit around doing nothing. They're just drawing out $250K a year on their investments. It's not going to do anything for them. So now they're weighing up what are they actually going to do with their life. And it was very just interesting reflecting on that. And I think something a lot of people don't think about. You're just so busy in the doing. And then you get there and it's like, well, it doesn't feel as good as it once thought. So I don't know. Have you seen any scenarios, Billy, with
several?
Yeah. What have you seen?
And I'm reluctant to admit this, but there's some brain rot meme that I remember that I saw online of Miley Cyrus.
Which one is it?
Well, I don't know if it's from a TV show or something. It's just, she said usually the journey is the part that you remember.
Yeah.
Right. So if you go, well, the journey's finished. I've made it. I've got everything. I've got all this money. I can do whatever I want.
Yeah.
the journey's the fun or fulfilling part.
Yeah.
So that doesn't end. Certainly not at 40 years old or 50 years old.
No.
So if you just go, yeah, I'm done now, I don't have to work, I can do whatever I want. Almost every time I've seen it, it's not good.
Yeah.
Not good at all. And our friend, we'll go back to Claude, but they're spot on here. Identity and purpose. You need identity and purpose. If you suddenly go from working 50 hours a week to zero, it is hard to replace that. The boredom problem, the peer gap. So all your friends are still working. They've got careers. They're busy. So you can't just go hang out with your mates or something.
Yeah.
And also longevity risk when if you retire at 40, you might be around for another 50 or 60 years. So even if you have 4 mil, if you get like a major, let's say a major market event or something like a big GFC type deal, or some family emergency where you need a bunch of money, like that is a very, very, very long time frame. So even if you feel like you're fully funded, that's a risk as well.
Yeah.
But I think the personal stuff and what's going on in your head is the main story, what you're getting at.
Yeah. Yeah.
And I've seen it several times, same thing. And usually what happens is they retire, and then within a year or two, they're losing their mind and they go back to work.
Yeah, the way I was thinking about it, and because, I always say to people, like, the fun's in the journey, not the destination, which is the old Miley's.
Oh, sorry, yeah. So you agree with Miley?
Yeah, I agree with Miley, but they're very good. And it's just so true. And it's even something I've just always reflected on my life, like doing different things. Like I thought when I reached my university career, I was like, this is going to be the best feeling. And I did it. And then I was like, all right, now what? So I've like climbed that peak and then I'm like, what's happening next? And then like, there's so many times I was even chatting with my wife around, it's like, oh, you buy your first home and it feels like the best thing ever. And then you get it and you're like, oh, okay, now what? But it's dangerous if you can't grapple that. And what I have seen with clients before is they just keep building and getting dollars in the bank just for the sake of literally getting dollars in the bank. And it like literally means nothing. And they're just in this like rat race, this like on the just constantly pedaling. And there's just like no end in sight whatsoever. And the way I was thinking about it when you were talking is kind of like what we were saying earlier around with the likes of like SpaceX and OpenAI and the financial markets, where there's kind of like a finite amount of capital around, and that has to go somewhere. For us as individuals, I think there's kind of like a finite amount of attention you then have. And if all of your attention's always been put towards your work, your career, and then your business, and then you take that away, I could tell you right now, if that was me in that situation, and then I'm just sitting and I've got no plan, like I would be guaranteed getting myself into trouble. Like I would be, binging out. I'd probably be eating a lot of food. I would just, who knows? Like I could be doing anything. If you don't have a goal or anything meaningful to then wake up for, like the attention has to go somewhere, and it could go to bad things or unless you figure out what are those good things that really mean something for you. So I'm sure there's going to be other people that are out there and all listening in that have reached some form of financial freedom. And if you're lucky enough, like some of the clients I was chatting with in the last few weeks to get there, it can be that part of your life, I think, could actually be trickier and more complex than all of what you've done to get to that point.
Yeah, because if you have too much choice,
yes,
you can do anything.
Yeah.
Which sounds good.
Yes. Yeah.
But then how do you make it? What's the decision framework? What do you actually do?
Yeah.
So financial freedom is still awesome, but it doesn't mean okay, I'm retired, I'll just do fun stuff and that's it. Because that's not going to be fun for very long.
No. And that's why I think like the whole FIRE movement, I can't get around it.
That's bullshit. When you want to get to financial freedom.
Yeah.
But that doesn't mean you then don't earn any income or do anything productive. So if you get to financial freedom, you can take a lower paying job that gives you more satisfaction. You decide you're going to start a business, and it's fine if you go without income for 3 years. So you've got more choice. But it's not, that's it, I'm going to live off this capital for the next 50 years.
Yeah. And I always look at like money or wealth as really an amplifier. So if you're a good person, you can do more good with that, wealth that you create. Or if you're a bad person, you're going to get into trouble. You can do more of the same things and create more chaos, I suppose, in the world that we live in. But really it is creating optionality. But then with optionality, it's kind of like one of those things is where there's too much choice and too many pathways you can go down. Sometimes that's actually a major problem because you have analysis paralysis and then you take no action. And I've seen that with some clients with the planning that we've then done is we've done all this amazing advice and then they just analysis paralysis till the cows come home. and they're just assessing like, oh, but what if we did this? But then, oh, okay, but what if we did this in like another 10 more years? And then what ends up happening? Let's take no action.
Yes.
I've seen that so many times.
Yes.
And it's super frustrating.
Sometimes the best advice is no change.
Yeah.
Yeah. Some people think you need to change things all the time, take action, to look at all these options, choose an option. Sometimes it's not, just leave it.
Yeah. And I guess in closing, like what I said to these individuals that I was chatting with, like they're likely going to be working with me moving forward. So I'm going to help them through this, problem that they're encountering at this point in time. But if you're, in this sort of a scenario and you haven't reached out to a financial advisor, like that might be a good first step, but it doesn't always necessarily need to be a financial advisor. It could be a consultant, could be a business coach that you might be working with as well. I think it's just important to have a soundboard in there with you, because they're going to be able to pop spot those blind spots, bird's eye view down on your scenario when you're generally going to be acting more out of emotion, logic. I think the most important part to get through that process is just have a soundboard, something you can bounce these ideas off, and then through that, it will either confirm what you're thinking or possibly promote some other ideas or areas that you hadn't necessarily had thought about in the past. And I had another conversation with a business owner last week who's looking at exiting out of their business entirely into it. They're totally fed up with what they've been doing. So say like me, exiting out of advice and don't want anything to do with it. And then they're like, so what am I going to do with myself now? Like, where do I pour my energy and time in? So I think my advice there would just be find some people, whether it is an advisor, someone you can actually soundboard off, because it's a critical point to get through in life. Any closing remarks there, Billy?
No, I'm just wondering if there's like support groups for these people. Well, because you want to talk to someone who's been through that, who's gone to retire, and then 2 years later gone, I'm miserable, I'm hitting rock bottom, and then they've found a way back out of it.
Well, genuinely, like what works there for me is because I'm a part of the entrepreneurs organization. Like I see people who have like started business, done massive exits. I know one guy that did a massive exit, went into a spiral and a bit of a depression. He's now bought his business back after like 3 to 5 years at a lower price. He's gone back in. But yeah, he did the big sell and exit, and now he's back in the game. So, but it's amazing being able to speak with people who have done certain things. So if you can just seek out people and find those people, or be a part of a community like EO, if you're in business, there are other communities like that, like worth their weight in gold. So we've covered a lot today, Billy. Any final remarks on any of the topics?
Good place to wind up.
With nothing else, as always, hope you guys are getting value out of what we are speaking about. And if so, 5 stars, Spotify and Apple helps us out a lot. And if you've got any comments, please leave them and let us know what you want to hear us talking more about. But until next time, we'll see you then.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.